Welcome to the deep dive. We're really thrilled you're joining us today because we are starting with a premise that fundamentally breaks the conventional wisdom of how success is supposed to work.
It really does. It flips it completely upside down.
Right. So consider this paradox. A highly educated finance professional, someone with top-tier academic credentials, decades of market experience, and access to the most sophisticated analytical tools on Wall Street can be completely, utterly destroyed in the market.
Just lose absolutely everything.
Everything. Yet, on the other hand, a humble janitor with no formal financial training, no college degree, someone who just spends their days sweeping floors and chopping firewood, can quietly amass an $8 million fortune.
Yeah, which sounds made up, but it happens.
It happens. So how does that happen? How is that dynamic even possible in a field that we are constantly told is built entirely on hard math, rigid spreadsheets, and, complex quantitative algorithms?
It is the ultimate paradox of the financial world. And it perfectly sets the mission for our discussion today. We are exploring the soft skills of finance.
The soft skills.
Right. We're unpacking the reality that doing well with money has surprisingly little to do with raw intelligence or technical prowess, and almost everything to do with behavior.
Yeah.
We are drawing on some profound insights regarding the psychology of money today, specifically looking at the deeply emotional, highly psychological, and often entirely counterintuitive ways that human beings interact with wealth, risk, and happiness. We really want to deconstruct how people actually operate in the real world rather than how theoretical economic models suggest they should.
And I think that distinction between the theoretical and the behavioral is, it's where the entire game is played.
Absolutely.
And it highlights this invisible divide between technical intelligence and behavioral discipline. There's a story from the source material that illustrates this divide perfectly, involving a brilliant tech executive.
Oh, this guy.
Yeah, this individual was undeniably a genius in the technical sense. In his 20s, he designed and patented a key component in Wi-Fi routers.
So he was legitimately brilliant.
Yeah, right. He built and sold companies. By any standard metric of success, he had won. But his relationship with money was driven by deep insecurities and this bizarre need for dominance.
The behavioral profile of this executive is fascinating because it demonstrates how high intelligence can sometimes inversely correlate with financial discipline.
Like they cancel each other out.
Yeah. Arrogance often scales with intellect. He was known to carry around a stack of $100 bills several inches thick, not for utility, obviously, but purely as a prop to show off to anyone he encountered.
And the escalation of that behavior is where it gets truly surreal. One afternoon, he hands a colleague several $1,000s in cash, tells him to go to a local jewelry store and buy a handful of $1,000 gold coins.
Solid gold coin.
Yes. And an hour later, this tech genius and his friends are standing on a dock looking out at the Pacific Ocean. They proceed to throw these solid gold coins into the sea.
Skipping them
across the water like rocks, laughing and arguing over whose coin went the furthest.
It is a staggering display of financial nihilism.
That's the perfect phrase for it.
And it wasn't an isolated incident. Shortly after that coin-skipping event, this same executive was in a hotel restaurant and accidentally knocked over a lamp, shattering it.
Right.
When the hotel manager politely informed him that the lamp cost $500 and would need to be replaced, the executive's response wasn't an apology. He pulled a brick of cash from his pocket, peeled off $5,000, handed it to the manager, and essentially told him to get out of his face and never insult him again.
Just insane.
He was using capital not as an asset, but as a weapon for ego defense.
Let's pause on that, because the psychology of using capital as a weapon is critical. He wasn't buying a lamp.
No.
He was buying the submission of the hotel manager. He was paying a $4,500 premium just to assert dominance. And of course, behavior like that has a shelf life.
It always does.
He eventually went completely broke. All the patents, the early success, the raw processing power of his brain, none of it could protect him from his own behavioral catastrophic failures. Which brings us to the exact opposite end of the spectrum, a man named Ronald Read.
Ronald Read is the perfect behavioral counterweight. He spent 25 years working as a gas station attendant in rural Vermont, followed by 17 years sweeping floors as a janitor at a JCPenney.
And he was the first person in his family to graduate high school, right?
Yes. He bought a modest two-bedroom house for $12,000 when he was 38 years old and lived there for the rest of his life. His primary hobby was chopping firewood. He lived a life of complete, unassuming routine.
Yet, when Ronald Read died in 2014 at the age of 92, He made international headlines. Out of the nearly 3 million Americans who passed away that year, fewer than 4,000 had a net worth exceeding $8 million.
Which is a tiny fraction.
Tiny. And Ronald Read was in that extreme statistical minority. He left $2 million to his stepchildren and more than $6 million to his local hospital and library. The people who knew him were totally baffled. They assumed he must have inherited a secret fortune or won the lottery.
But the reality was far more mundane and therefore much more profound. There was no secret windfall. He simply saved what little capital he could aggregate from his blue-collar wages, deployed it into blue-chip stocks, and then he exercised the ultimate financial superpower.
He just waited.
He just waited. He let compounding do the heavy lifting for over half a century.
To really crystallize why this is unique, we have to contrast Ronald Read with a man named Richard Fuscone. Fuscone was frequently in the financial news just prior to Ronald Read's death, and he was everything Read was not.
The exact opposite.
Right. Fuscone was a Harvard-educated executive at Merrill Lynch. He had the prestigious MBA. He was featured on prominent 40 under 40 lists. He was so successful in the traditional sense that he retired in his 40s to pursue philanthropy.
But much like our coin-skipping tech executive, Fuscone's internal behavioral framework was entirely disconnected from his technical expertise. In the mid-2000s, he utilized massive amounts of leverage to expand an 18,000-square-foot mansion in Greenwich, Connecticut.
18,000 square feet.
Yeah. This property had 2 elevators, 2 pools, 11 bathrooms, 7 garages, and required a maintenance burn rate of $90,000 every single month.
$90,000 a month just to keep the lights on and the pools heated? And when the 2008 financial crisis systematically dismantled the credit markets, Fuscone's leverage became a trap.
He was entirely wiped out.
He eventually stood before a bankruptcy judge and declared zero income. That massive Greenwich estate was auctioned off in foreclosure for 75% less than its estimated value.
If we pull back and look at the macro implications of Read and Fuscone existing in the same universe, it forces a realization about the nature of finance itself. Think about any other highly technical profession. You will never find a story about a janitor with 0 medical training who quietly practices surgery in his garage and eventually performs a better heart transplant than the chief of surgery at Mass General.
No, never.
You will never see a gas station attendant draft architectural blueprints that outperform the structural integrity of a skyscraper designed by a top engineering firm.
Right. It's statistically and practically impossible. The technical barrier to entry in those fields prevents behavior from overriding skill.
Precisely. But in finance, specifically in investing and wealth accumulation, the technical barrier is secondary to the behavioral barrier. The difference between Ronald Read and Richard Fuscone wasn't an information advantage. Fuscone had access to infinitely more data, better research, and superior market mechanics.
He had everything.
The difference was entirely behavioral. Read possessed immense patience, while Fuscone was driven by ego and greed. That single behavioral delta completely eclipsed a massive chasm in education, background, and technical expertise.
So as you are listening to this, analyzing your own portfolio and your own career trajectory, the question isn't whether you have the right spreadsheet or the fastest algorithm. The question is whether you are managing your own internal emotional thermostat.
That's a great way to put it.
Are you operating with the quiet discipline of a Ronald Read? Or are you secretly harboring the ego-driven leverage of a Richard Fuscone? Because losing control of your emotions can neutralize a genius-level intellect in a matter of months.
That internal emotional thermostat relies heavily on how we process the world around us, which introduces the concept of the empathy filter. It's the radical idea that fundamentally no one is actually crazy.
This is such a cool concept.
It is. When we observe the global economy, we see individuals and institutions making financial decisions that appear utterly incomprehensible to us. But the reality is that every single financial decision a person makes complete sense to them in that specific moment, based entirely on their unique lived experience.
I want to dig into the math of that lived experience because it's jarring. Your personal firsthand experiences with money and the economy make up perhaps 0.000000001% of what has actually happened in the world.
Practically nothing.
But those deeply visceral personal experiences make up 80% of how you think the entire world works. We are extrapolating massive macroeconomic beliefs from a microscopic sample size of personal trauma or personal triumph.
It is the ultimate cognitive anchor. We cannot escape the gravity of what we have personally felt. Take John F. Kennedy during the 1960 presidential election. When asked about his personal recollections of the Great Depression, he exhibited a rare moment of extreme self-awareness. He admitted he has zero firsthand knowledge of the suffering.
Because his family was fine.
Better than fine. His family possessed one of the great fortunes of the American 20th century. During the 1930s, while the country was starving, the Kennedy family was acquiring larger estates and hiring more domestic staff.
He actually noted that his only real exposure to the economic devastation was watching his father hire a few extra gardeners out of pity, just to give local men a wage so they could feed their families. Kennedy didn't truly grasp the magnitude of the Depression until he was reading historical accounts of it while studying at Harvard.
Exactly.
And the takeaway there is that you cannot recreate the visceral, paralyzing power of economic fear through academic study. The emotional scarring of a father who lost his business in 1932 cannot be downloaded into the brain of a wealthy student reading a textbook in 1958.
And that exact dynamic dictates modern market behavior as well. Consider Bill Gross, one of the most successful bond managers in history. His entire professional career coincided with a multi-decade generational collapse in interest rates.
And when rates fall, bond prices rise.
Right. Therefore, to Bill Gross, based on his specific lived experience, bonds were an invincible wealth-generating machine. But if you analyze the psychology of his father's generation, individuals whose formative financial years were defined by the hyperinflationary environments of the 1970s, they viewed bonds as guaranteed wealth incinerators.
Total opposites.
Neither perspective is inherently mathematically wrong. They're simply the result of different experiential lenses.
We see this exact cohort effect in the equities market, too. Let's say you were born in 1950. During your teens and 20s, the years where your brain is wiring its understanding of risk and reward, the stock market, adjusted for inflation, essentially went nowhere. It was a flat line.
So boring.
Right. Your foundational belief is that the stock market is a stagnant pool. But if you were born in 1970, the S&P 500 went up almost tenfold during your teens and 20s. Your foundational belief is that the stock market is a rocket ship. Those two cohorts are going to approach asset allocation with fundamentally incompatible worldviews for the rest of their lives.
And those differing lenses extend far beyond just navigating asset classes. They dictate our moral and ethical definitions of the global economy. There's a deeply challenging reality regarding how different cultures view industrialization. When Western observers look at certain manufacturing facilities in developing nations, they often see what they define as horrific, exploitative sweatshops.
Sure.
But if you talk to the individuals actually working on those lines, their baseline for comparison is entirely different.
Yes, there's a specific account of a Chinese factory worker who was responding to Western outrage over the working conditions at major electronics manufacturers. The Western media was appalled by the long hours and rigid structure, but this worker's nephew pointed out a brutal reality. Prior to securing that factory job, his aunt was working as a prostitute.
And the nephew explicitly stated that his aunt would vastly prefer to be exploited by an anonymous corporate entity for a steady wage than to have her physical autonomy violated daily for pennies. It's a harsh, uncomfortable truth that forces us to realize how differing infrastructure, varying degrees of poverty, and vastly different life options entirely alter the definition of opportunity. What looks like a human rights violation from the vantage point of a comfortable Western suburb looks like a literal lifeline from the vantage point of profound rural destitution.
I'm hung up on the mathematical friction of this empathy filter when it comes to everyday financial decisions, though, because understanding someone's background is one thing. But how do we reconcile the empathy filter with behavior that is objectively mathematically destructive?
You mean like the lottery?
Yes, exactly, the lottery ticket paradox. We know that the lowest income households in the United States spend roughly $400 a year on lottery tickets. At the exact same time, statistical studies consistently show that 40% of Americans cannot come up with $400 in cash for an emergency.
From a purely quantitative standpoint, it is indefensible. An expected return of negative 50 cents on the dollar. They are systematically setting fire to their only potential safety net in exchange for a statistical impossibility.
Right. My brain, as someone who follows markets, instantly rejects it. It's not just a bad investment, it's an active sabotage of their own financial survival. How do we apply the empathy filter here without just excusing bad math?
By understanding that they are not measuring utility in dollars, they are measuring utility in hope.
Utility and hope.
If we force ourselves to walk in those shoes, a completely different, albeit tragic, logic emerges. Imagine existing in a state of permanent financial precarity. You're living paycheck to paycheck, The structural realities of your local economy mean that prospects for higher wages are effectively non-existent. You intimately feel the reality that you cannot afford a reliable car, you cannot afford a vacation, you cannot buy a home in a neighborhood with well-funded schools, and you certainly cannot cash flow your children's college education without taking on crippling predatory debt.
So the traditional avenues of upward mobility are blocked, or at least perceived to be completely blocked.
Exactly. And in that highly constricted reality, purchasing a lottery ticket is not an investment strategy. It is the purchase of a psychological release valve. For those 3 days between buying the ticket and the drawing, it is the only time in their lives they are permitted to hold a tangible, socially acceptable dream of acquiring the good stuff that wealthier demographics take entirely for granted.
That makes so much sense.
The $400 isn't lost capital. It's a subscription fee to a fantasy of escape. We do not have to endorse the mathematical wisdom of the purchase. But if we want to understand human behavior, we must acknowledge the intense psychological utility of that transaction. It makes perfect emotional sense to them in that moment.
That reframes the entire discussion around financial literacy. We assume people make bad choices because they lack information, but often they have the information. They are just optimizing for a different emotional variable. And part of the reason we are all flailing around optimizing for the wrong variables is because, historically speaking, we are all absolute novices at this.
That is a crucial contextual layer. We judge ourselves and others incredibly harshly for making emotional financial decisions, forgetting that the modern financial landscape is a microscopic blip in human evolution.
We act as if managing a diversified portfolio is some innate human trait. But the very concept of retirement, the idea that you simply cease laboring in your 60s and survive for 3 decades on the yield of accumulated capital, is a brand new invention.
Very new.
Prior to the post-World War II economic boom, the retirement plan for the vast majority of human history was simple. You worked until you physically could not, and then you died shortly after.
The tools we use to navigate this new reality are practically infants. The 401k, the primary engine of American retirement, wasn't codified into law until 1978.
It's recent.
Very recent. The Roth IRA didn't exist until 1998. The mass democratization of consumer credit, index funds, and algorithmic trading, these are systems that are barely a single generation old.
There's an analogy that perfectly captures this disorientation. Think about dogs. Dogs were domesticated roughly 10,000 years ago. We've been breeding them for millennia to be companions. Yet, if a thunderstorm hits or a strange animal enters the yard, they instantly revert to the survival traits of their wild ancestors. They panic, they bark, they hide. 10,000 years of domestication can't completely override millions of years of evolutionary wiring.
And we are expecting the human brain, which evolved to optimize for immediate caloric survival and tribal social status, to flawlessly adapt to a highly abstracted delayed gratification system of digital wealth creation that is, at most, 50 years old. We aren't crazy when we panic sell during a market correction or over-leverage to buy a status symbol. We are simply displaying the wild traits of an organism that has not yet adapted to its new environment.
Which naturally brings us to two of the most powerful, invisible forces in that environment, luck and risk. We tend to view them as opposites, but they are actually siblings. They are the twin manifestations of the reality that the world is infinitely too complex to allow 100% of your actions to dictate 100% of your outcomes.
They are two sides of the exact same coin. To truly grasp how deeply luck and risk dictate outcomes, we can examine the origin story of Bill Gates. We universally acknowledge that Gates possesses a staggering intellect and an unmatched work ethic. But the variable of luck in his success is mathematically astounding.
Let's hear the math.
In 1968, there were roughly 303 million high school-age students on the planet. Of those, perhaps 100,000 lived in the Seattle metropolitan area, and of those, only about 300 attended Lakeside School.
And Lakeside School was arguably the only high school in the world at that time that possessed a computer terminal. It wasn't even a standard curriculum decision. A visionary teacher named Bill Dougal convinced the school's Mothers Club to use the proceeds from an annual rummage sale to purchase lease time on a teletype Model 33 terminal. So out of 303 million students globally, Bill Gates was handed a 1 in a million head start. He had thousands of hours of programming experience before most computer science professors even had access to the hardware.
Gates himself is profoundly intellectually honest about this. He has explicitly stated, if there had been no Lakeside, there would have been no Microsoft. His skill and ambition were the engine, but luck provided the entirely unique track.
But the narrative doesn't end there, because the doppelganger of that luck, the dark mirror of it, is risk. While Gates was at Lakeside, he had a best friend named Kent Evans. By Gates' own recollection, Kent was arguably the smartest student in the class, a true mathematical prodigy.
Smarter than Gates.
Exactly. And they shared the exact same boundless business ambition. They were constantly strategizing, planning to conquer the nascent computing world together. Kent Evans had the exact same skills, the exact same drive, and the exact same exposure to that one-in-a-million Lakeside computer.
Kent Evans could have easily been the co-founder of Microsoft. But Kent never graduated high school. He tragically lost his life in a mountaineering accident. If you look at the actuarial tables, the odds of a high school student dying on a mountain are roughly 1 in a million.
So you have the exact same magnitude of force, a 1-in-a-million statistical anomaly working in entirely opposite directions. One probability vector propelled Bill Gates toward unimaginable wealth and historical impact. The other probability vector violently ended Kent Evans' life before it even began.
When you lay the math out like that, it forces a radical reevaluation of how we judge success and failure. The human brain is desperate for narrative order. We prefer clean, linear stories of cause and effect. A causes B, hard work causes success, laziness causes failure. But reality is a chaotic web of probabilities.
This leads to a massive fundamental attribution error in finance, doesn't it? When we analyze someone else's wild success, we actively ignore the element of luck, because pointing out luck feels petty, or it sounds like we are just jealous of their achievements. Conversely, when we observe someone else's failure, our brains immediately seek a flaw in their character or their strategy. We assume they made bad decisions.
But the cognitive dissonance is spectacular when we turn that judgment inward. When we judge ourselves, the script flips entirely. If your portfolio outperforms the market, you don't attribute it to a lucky macroeconomic tailwind. You attribute it to your own proprietary genius and rigorous analysis.
And of course, I'm brilliant.
Right. But if you're portfolio creators, you rarely admit it was due to your own flawed thesis. You blame it on unforeseeable risk, algorithmic manipulation, or bad luck.
We weaponize risk to excuse our failures, and we ignore luck to validate our egos. And this inability to properly weight luck and risk makes idolizing specific business figures incredibly dangerous. Look at Cornelius Vanderbilt. He constructed his massive railroad and shipping empire by flagrantly, unapologetically breaking the law. He famously scoffed at the legal system, saying, "What do I care about the law? Ain't I got the power?"
Today, business schools study him as a scrappy, relentless visionary who refused to let bureaucratic red tape stifle innovation. We lionize his aggression.
But think about the razor-thin margin of probability there. If the judicial system of the 19th century had been slightly more robust, or if a specific judge had decided to make an example of him and crushed his empire, Vanderbilt wouldn't be remembered as a visionary. He would be relegated to the history books as a reckless, delusional criminal who destroys shareholder value through illegal arrogance. The line dividing a lauded genius from a disgraced criminal is sometimes nothing more than a favorable coin flip.
Even the most analytical minds are subject to this ambiguity. Benjamin Graham is universally revered as the father of value investing. He is the man who taught Warren Buffett. Graham wrote the definitive text on the absolute necessity of strict diversification and margin of safety. Yet, if you look at the actual attribution of his lifetime wealth, the vast majority of his personal fortune was generated by explicitly breaking his own rules.
He bought Geico, right?
Yes, he took a massive, highly concentrated, illiquid stake in the insurance company Geico.
And Graham was self-aware enough to recognize the paradox. He later wrote about the Geico investment, questioning whether it was one supremely shrewd, calculated decision or simply one massive, lucky break that bailed out a mediocre overall track record. He admitted it was nearly impossible to tell the two apart.
So how do you actually apply this understanding to your own life? It means you have to stop trying to reverse engineer the exact decisions of extreme outliers. You cannot emulate Bill Gates' success because you cannot emulate the exact sequence of 1 in a million probability strikes that created his environment. Instead of focusing on specific individuals, focus on broad, directional patterns.
And perhaps more importantly, it requires a profound level of forgiveness. You have to leave room for forgiveness when your own plans fail, recognizing that you may have done everything right, but were simply on the wrong side of the probability curve. And you must leave room for grace when judging the failures of others. As the NYU professor Scott Galloway so brilliantly put it, nothing is as good or as bad as it seems.
Embracing that humility naturally leads us to a psychological framework that is perhaps the most difficult financial skill for a high achiever to master, the concept of enough.
I know.
If your expectations and your desires rise at a faster velocity than your actual capital accumulation, there is zero logical utility in striving for more. You will forever exist in a state of deficit, regardless of your tax bracket.
This is the phenomenon of the moving goalpost. And the historical record is littered with individuals who achieved absolute financial invincibility, yet destroyed themselves because they couldn't stop moving the goalpost. Let's look at Raja Gupta.
Oh, this is a tragic one.
His origin story is the stuff of legend. He was orphaned as a teenager in the slums of Kolkata, India. Through sheer intellect and drive, he navigated his way to the highest echelons of global finance, eventually becoming the CEO of McKinsey & Company. By 2008, his personal net worth was estimated at $100 million.
Let's contextualize $100 million. If you simply park that capital in conservative treasury yields or a basic index fund generating a 5% return, it yields $5 million a year in passive income. That equates to nearly $600 an hour, 24 hours a day, 7 days a week, without ever touching the principal. From a survival and lifestyle standpoint, Rajat Gupta had won the game. He could have spent the rest of his life doing absolutely anything he desired.
But $100 million wasn't enough. Because he was no longer comparing himself to the general population. He was sitting on the board of directors for Goldman Sachs. His peer group consisted of billionaires. In that specific microenvironment, being a centimillionaire felt inadequate. So during the chaos of the 2008 financial crisis, Warren Buffett was quietly negotiating a massive $5 billion liquidity injection to save Goldman Sachs. Gupta learned of this highly classified deal during a board meeting.
And what did he do with that privileged information? 16 seconds after disconnecting from that board call, Gupta dialed a hedge fund manager named Raj Radratnam to leak the information. It was the most blatant, textbook definition of insider trading.
Rajaratnam used the tip to generate a rapid $1 million profit, and the SEC ultimately calculated that Gupta's ongoing leaks generated roughly $17 million in illicit gains for his associates. But consider the asymmetry of the risk. For a fraction of his existing net worth, Gupta risked everything. He was caught, prosecuted, and sent to federal prison. His reputation, built over a lifetime of struggle and brilliance, was permanently incinerated.
Bernie Madoff presents an equally perplexing case study in the pathology of more. We remember Madoff exclusively as the architect of the most devastating Ponzi scheme in human history. But what is consistently forgotten is that long before the fraud began, Madoff had built a highly successful, entirely legitimate market-making firm.
Right. His legitimate business was a pioneer in electronic trading. It was reportedly generating between $25 and $50 million a year in perfectly legal profits.
So we must ask the core psychological question. Why do individuals who already possess tens or hundreds of millions of dollars, people who have achieved absolute financial security for themselves and their descendants, willingly risk absolute ruin for a marginal increase in capital?
Why do they do it?
It is because they lack an internal metric for enough. They have outsourced their financial contentment to social comparison, and social comparison is a ladder with no top rung.
Let's trace the mechanics of that ladder, because the math of social comparison is brutal and unwinnable. Imagine a rookie Major League Baseball player who just signed a contract for $500,000 a year. By any statistical measure of the global population, he is incredibly wealthy. He can afford a great home, luxury cars, and financial security. But he walks into the clubhouse, and his locker is next to Mike Trout, who is playing on a $430 million contract. Suddenly, the rookie's brain recalibrates. Compared to his immediate peer, he feels impoverished.
Now elevate it. Mike Trout is earning roughly $36 million a year in salary. He's the apex of his profession. But perhaps Trout attends a charity gala and sits next to a top-tier hedge fund manager who took home $340 million that year. In that room, Trout feels like the poor relation.
But the hedge fund manager isn't immune. That manager, pulling in $340 million, looks at the annual rankings of the top 5 hedge fund managers, who all earned over $770 million. Those top 5 managers look at Warren Buffett, whose personal wealth increased by $3.5 billion in a single year. And Warren Buffett can look at Jeff Bezos, whose net worth surged by $24 billion in a single year.
It is a mathematically unwinnable game. If your definition of success is having more than the person next to me, you are destined for perpetual dissatisfaction, because there will always be someone further up the tail of the distribution. The only way to win the game of social comparison is to refuse to step onto the playing field to begin with. You have to establish your own internal metric of enough.
Warren Buffett actually summarized this pathology perfectly when discussing the collapse of long-term capital management. LTCM was a hedge fund staffed by literal Nobel laureates in economics. They were the smartest guys in the room. And they used extreme leverage to chase marginal returns, ultimately blowing up the fund and nearly taking down the global financial system. Buffett looked at them and said, to make money they didn't have and didn't need, they risked what they did have and did need.
It is the definition of an irrational trade. Why would you place something indispensable, your freedom, your reputation, your family's security on the table to gamble for something entirely superfluous? We see it repeatedly because ambition that is not tethered to a defined sense of enough is merely a countdown to self-destruction.
So, to you listening right now, have you explicitly defined your enough? I don't mean a vague aspiration, I mean a hard number or a specific lifestyle metric. Because accepting enough does not mean you are lazy or that you are leaving opportunity on the table. It means you have the wisdom to recognize that an insatiable appetite will eventually push you past the point of optimization and directly into the zone of regret. You must construct a firewall around your reputation, your freedom, and your happiness, and never risk them for a potential extra dollar.
Now, if recognizing enough acts as your defensive shield, the concept of compounding is your offensive engine. But as we explore the mechanics of compounding, we run into a massive cognitive roadblock.
Which is?
Exponential growth is fundamentally unintuitive to the human brain. We are wired to process linear relationships, so we consistently underestimate the sheer world-altering power of exponential math, and we constantly search for complex interventions when simple time is usually the correct answer.
To really grasp how our brains fail at this, I want to look at a brilliant analogy regarding planetary climate change, specifically the ice ages. For decades, the scientific community was baffled by what caused the Earth to freeze over into massive, miles-thick ice sheets on 5 separate occasions. The prevailing theories all assumed that an event of that magnitude required a catalyst of equal magnitude. They hypothesized about apocalyptic volcanic eruptions blocking out the sun or shifting tectonic plates radically altering ocean currents.
They're looking for a dramatic linear cause to explain a dramatic effect. But a Russian meteorologist named Vladimir Kupin eventually unlocked the true mechanism, and it was shockingly subtle. It had nothing to do with brutal apocalyptic winters. The catalyst for an ice age was simply moderately cool summers.
Let's break down the mechanics of that, because it maps perfectly to portfolio management. Due to slight orbital shifts, the Milankovitch cycles, a particular hemisphere might experience a summer that is just a degree or two cooler than average. It's barely noticeable. But that slight drop in temperature means that not all of the previous winter's snow melts. You are left with a thin base layer of snow that survives the summer.
And this is where the compounding feedback loop initiates. Snow is highly reflective. It has a high albedo. That leftover base layer reflects incoming solar radiation back into space, which slightly cools the surrounding atmosphere. Because the atmosphere is now slightly cooler, it makes it statistically easier for more snow to accumulate during the following winter.
And when the next summer arrives, it has to melt an even larger snowpack in a cooler environment. So a larger base layer survives, reflecting even more sunlight, lowering the temperature further. It is a runaway exponential cycle. Within a geological blink of an eye, a thin layer of unmelted snow compounds into a planetary ice sheet covering half the globe.
It is the perfect metaphor for wealth accumulation. You do not need a tremendous world-shattering force like a massive IPO windfall or perfectly timing a market bottom to create an extraordinary financial result. You simply need a small positive change that is allowed to feed on itself uninterrupted over an extended period. And there is no greater living embodiment of this exponential magic than Warren Buffett.
We hold Buffett up as the ultimate oracle of stock picking. And yes, his ability to analyze a balance sheet is unparalleled, but the true math behind his wealth is a cognitive illusion. At the time this data was compiled, Buffett's net worth was roughly $84.5 billion. But here is the statistic that completely breaks your brain's linear processing. $84.2 billion of that total was accumulated after his 50th birthday. Furthermore, $81.5 billion of his wealth came after his 65th birthday, the age when a normal person qualifies for Social Security.
It completely dismantles the narrative we've built around him. We write thousands of complex books analyzing his management methodologies and his motive-evaluating frameworks. But his true secret isn't merely his 22% average annual return. His secret is the duration of the compounding. He began investing seriously when he was 10 years old.
Let's test that logic with a thought experiment. What if Warren Buffett had lived a more conventional life? What if he spent his 20s traveling, finding his passion, and didn't scrape together his first $25,000 to start investing until he was 30 years old? Let's assume he still maintained his world-class genius and generated that incredible 22% annual return. But, like a normal person, he decided to retire at age 60 to play golf and spend time with his grandkids. What would his net worth be at age 60?
The math is brutal. It wouldn't be $84.5 billion. It would be $11.9 million.
Wow.
That is 99.9% less than his actual accumulated wealth. All the books written about his stock-picking prowess miss the fundamental mathematical driver, the sheer relentless passage of time.
We can further validate this by comparing Buffett to Jim Simons, the legendary mathematician who founded the quantitative hedge fund Renaissance Technologies. Simons is arguably the greatest trader to ever live. He compounded his capital at an astonishing 66% annually. That is 3 times Buffett's rate of return. But Simons didn't find his investing stride until he was 50 years old. Because his runway for compounding was significantly shorter, Simons' net worth is roughly $21 billion, 75% less than Buffett's.
What's fascinating here is how our brains aggressively fail to intuitively grasp this math.
Yeah.
We are hardwired for addition, not multiplication. If I ask you to calculate 8 plus 8 plus 8 plus 8, your brain solves it instantly.
Sure, 32.
But if I ask you to calculate 8 times 8 times 8 times 8, your brain stalls out and requires external tools. It's the same cognitive blind spot we have with technological progress.
Right, the data storage example. From 1950 to 1990, a span of 40 years, the total capacity of computer hard drives increased by about 296 megabytes. But from 1990 to the present day, it gained over 100 million megabytes. To our linear brains, it looks like a sudden, inexplicable explosion of technology. But it's not an explosion. It is simply the math of compounding finally reaching the steep, parabolic vertical section of the curve.
So the actionable lesson here is surprisingly simple, yet incredibly difficult to execute. The most powerful manual on finance shouldn't be a 500-page tome on algorithmic trading strategies. It should be a single page with 4 words, shut up and wait.
Shut up and wait.
Superior investing isn't about chasing the highest possible return in any given year, because maximum returns inevitably require maximum risk, which usually leads to a blow-up. Superior investing is about earning pretty good, consistent returns that you can sustain for the longest possible period of time without interrupting the compounding cycle.
But sustaining those returns over decades introduces a massive secondary challenge. You have to avoid blowing up. You have to survive. Which brings us to the profound difference between getting wealthy and staying wealthy. They require 2 entirely distinct, almost contradictory mindsets.
Getting money requires taking risks. It requires a deep well of optimism. You have to be willing to put your capital on the line, start a business, or bet on a future that doesn't exist yet. But keeping money. The retention of capital requires the exact opposite psychological profile. It requires extreme humility, a frugal disposition, and a healthy, persistent dose of paranoia.
To illustrate this dichotomy, let's go back to the volatility of the 1929 stock market crash and examine the fates of 2 highly successful men. First, we have Jesse Livermore. He was arguably the most legendary trader of his era. He saw the macroeconomic warnings leading up to the crash, and he aggressively shorted the market. In October 1929, while the global economy was collapsing and other traders were literally jumping out of windows in despair, Livermore made the modern equivalent of $3 billion in a single day. He returned home to his terrified family and announced that they were now fabulously, unfathomably wealthy.
He perfectly executed the offensive strategy. Now, contrast him with Abraham Jermansky. Jermansky was a multimillionaire real estate developer who got swept up in the roaring optimism of the 1920s and heavily leveraged his wealth into the stock market. When the crash occurred, his leveraged positions were obliterated. He was completely wiped out. The last confirmed sighting of Jermansky was him wandering aimlessly down Wall Street, tearing ticker tape into pieces in a state of absolute shock. It was widely assumed he ended his own life shortly after.
It's a tragic, stark contrast between the genius who anticipated the risk and the optimist who was destroyed by it. But here is the historical twist that proves the point. Fast forward just 4 years to 1933. Jesse Livermore, overflowing with the invincibility complex that comes from a $3 billion win, began taking larger and increasingly reckless risks. He lost his paranoia. The market eventually turned against his positions. He lost everything, accumulated massive debts, vanished for a period, and eventually he too ended his own life. Both Livermore and Germansky possessed the incredible skill required to get wealthy, but both entirely lacked the psychological apparatus required to stay wealthy.
This tragic reality leads to what behavioral economists call the barbelled personality. It sounds like an oxymoron, but mastering it is the key to financial survival. On one end of the barbell, you must be deeply fundamentally optimistic about the long-term trajectory of the world. You have to believe that innovation and human ingenuity will continue to drive markets up and to the right over a multi-decade horizon.
But on the other end of the barbell, at the exact same time, you must be hyper-paranoid about the short-term obstacles that could wipe out your capital before you ever reach that optimistic future. You have to recognize that the path to long-term growth is paved with short-term landmines.
It requires building an impenetrable margin of safety. Think about Sequoia Capital, one of the most successful venture capital firms in the history of Silicon Valley. They backed Apple, Google, WhatsApp, the titans of the modern economy. When Michael Moritz, the billionaire head of Sequoia, was asked how his firm managed to survive and dominate for 40 years while thousands of competing VC firms flamed out and vanished, he didn't credit their superior algorithms or their elite networking. He simply stated, "We've always been afraid of going out of business." Pure, unadulterated fear of ruin was their guiding operational principle.
Contrast Sequoia's paranoia with the story of Rick Guerin. Most people in finance revere the legendary partnership of Warren Buffett and Charlie Munger. But in the 1970s, that partnership was actually a trio. Rick Guerin was the third member of the syndicate. He made investments alongside them. He interviewed management teams with them. By all accounts, Guerin was just as intellectually gifted as Warren and Charlie. But he suffered from a fatal behavioral flaw. He was, as Buffett later described it, in a hurry.
Yes, Guerin didn't want to wait for compounding to do the work at its natural pace. He wanted to accelerate the timeline. So he heavily leveraged his portfolio with margin loans to maximize his upside. But when the vicious bear market of 1973 and 1974 hit, the stock market crashed by nearly 70%. Guerin's margin loans got called in by his brokers. To cover his debts and avoid total bankruptcy, he was forced into a position of absolute weakness. He had to sell his shares of Berkshire Hathaway back to Warren Buffett for under $40 a share. He was smart enough to pick the right asset, but because he lacked a margin of safety, he didn't survive to see the compounding happen.
Wait, let's pause on that. You're saying the margin of safety isn't just a spreadsheet buffer, it's an emotional buffer. It's the mechanism that prevents you from becoming a forced seller during a panic.
Precisely. Because if your spreadsheet says you can survive a 30% drawdown, but your psychology breaks at a 20% drawdown, you still sell at the bottom. A margin of safety ensures that your capital can survive reality, because reality is inherently chaotic.
If you look at the macro level of the United States over the last 170 years, survival is the defining narrative. Over that period, the U.S. economy endured 9 major wars, 33 severe recessions, 4 presidential assassinations, a global pandemic in 1918 that killed 675,000 Americans, and the statistical reality that 99.9% of all companies created eventually failed.
It is a staggering, relentless litany of destruction. Any rational observer looking at that timeline would assume continuous economic collapse.
Yet, despite all of that relentless chaos, the standard of living in the U.S. increased 20-fold over that exact same time frame. Progress amidst destruction isn't an anomaly. It is the standard operating procedure of the global economy.
This means your personal financial plan is completely useless if it relies on a frictionless reality. You cannot build a strategy that assumes uninterrupted bull markets and perfect health. The most vital component of your plan is planning on the plan, not going according to plan. You need a frugal baseline, robust cash reserves, and flexible thinking so that when the inevitable chaos strikes, you are an observer, not a victim.
Understanding that chaos brings us to a mathematical reality that governs almost every aspect of success, yet is wildly misunderstood: the concept of long tails. In finance, in business, in art, and in life, long tails, the absolute furthest, most extreme ends of a distribution of outcomes, drive almost everything. The terrifying yet incredibly comforting truth is that you can be dead wrong half the time and still amass an absolute fortune.
It is a beautiful counterintuitive concept. We assume that great success requires a high batting average. But in reality, it just requires a few massive home runs. Look at the high-end art market. Heinz Berggruen fled Nazi Germany and eventually built himself into one of the most successful art dealers in history, amassing a billion-dollar collection of works by Picasso, Klee, and Matisse. Did Berggruen possess some supernatural foresight that allowed him to only select masterpieces? Absolutely not. He essentially invented the index fund model for fine art. He bought vast, overwhelming quantities of art, fully knowing and accepting that 99% of his purchases would be mediocre duds. He simply waited for the 1% of mega winners, the rare Picassos, to exponentially pay for all the failures.
Walt Disney operated his empire on the exact same mathematical principle. Before Disney was an untouchable global icon, his studio was constantly teetering on the edge of bankruptcy. By the mid-1930s, he had produced over 400 cartoons. Most of them were critically beloved, but financially they were disasters. He was deeply in debt and struggling to make payroll. And then he produced Snow White and the Seven Dwarfs. The 83 minutes of that single film generated such an overwhelming tidal wave of revenue that it paid off all of the company's accumulated debts, funded a massive new state-of-the-art studio, and permanently cemented his legacy. Hundreds of agonizing flops entirely erased by one massive tail event.
We see this exact dynamic dominate the stock market. If you analyze the Russell 3000 index, which tracks the performance of the 3,000 largest publicly traded U.S. companies from 1980 to the present, the underlying data is shocking. Over that time frame, roughly 40% of those public companies lost at least 70% of their value and simply never recovered. They effectively went to zero. We're talking about massive, culturally dominant companies like Coleco, which produced global blockbusters like Terminator 2 and Rambo, and then just evaporated into bankruptcy.
So effectively, half the companies in the index were complete failures. Yet, the Russell 3000 index as a whole increased 73-fold over that exact same period. How is that mathematically possible? Because of the 7% of companies that were massive long-tail winners. Look at a behemoth like Amazon. If you look at Amazon's product history, it is a graveyard of failed ideas. Remember the Fire Phone? It was a catastrophic flop that cost the company hundreds of millions. But Amazon's trillion-dollar valuation is driven almost entirely by its tail events. The unprecedented success of Amazon Prime and Amazon Web Services. The extreme tails completely overwhelm the massive volume of flops.
What is truly crucial for you listening to understand is that tail events don't just apply to corporate business models or venture capital portfolios. They apply directly to our individual behavior. We have behavioral tails.
Yes, the mathematics of behavioral consistency. There's a brilliant hypothetical model that compares 3 investors who each save exactly $1 a month from the year 1900 to 2019. Let's look at their strategies. Sue is relentless. She invests her dollar every single month, rain or shine, through bull markets, depressions, and world wars. Jim is cautious. He invests during the good times, but the moment a recession is officially declared, he sells his entire portfolio and sits in cash until the recession ends. Tom is reactive. He holds on a bit longer, selling a few months after a recession begins and waiting a few months after it ends before buying back in.
The divergence in their final outcomes is staggering. Sue, the relentless accumulator, ends up with over $435,000. Jim, the cautious market timer, has about $257,000. Tom, the reactive trader, has only $234,000. Sue wins by a massive, almost $200,000 margin. And the reason why is profound. Out of the 1,428 months in that 119-year period, the U.S. economy was technically in a recession for only about 300 months. By simply keeping her emotions in check and remaining fully invested during that specific 22% of the timeline when everyone else was panicking and liquidating, Sue generated her massive outperformance. How you behave in the brief, highly concentrated moments of terror dictates your lifetime returns infinitely more than what you do during the years of boring upward drift.
So we are systematically underestimating how normal it is to fail and underestimating how much the rare successes actually matter. The lesson here is to stop beating yourself up for having bad ideas or making bad investments. You are going to have duds. Everyone does. The greatest minds in history are full of terrible ideas. Think about a master comedian like Chris Rock. When you watch his flawless, hilarious Netflix special, you are witnessing the tail result. You are seeing the final 1%. What you don't see are the hundreds of nights he spent in small, dimly lit, stressful comedy clubs, testing out hundreds of terrible jokes that completely bombed in front of hostile crowds. You just don't see the losses.
As the legendary investor George Soros summarized, it's not about how often you are right or how often you are wrong. It's about how much money you make when you are right and how much money you lose when you are wrong. You have to size your risks so that you survive your inevitable mistakes, ensuring you are still at the table when the tail events finally arrive.
Which brings us to the foundational question underlying all of this analysis. After all this intense discussion about risk management, compounding, survival, and tails, we have to step back and ask, what is the actual point? What is all this accumulated capital actually for? The highest form of wealth isn't the ability to purchase a depreciating luxury asset. It is the ultimate psychological dividend of waking up every single morning and being able to say, I can do whatever I want today.
This got straight to the core of human psychology and the concept of control. In 1981, a prominent psychologist named Angus Campbell published a massive, comprehensive study analyzing the determinants of human well-being. He controlled for every conceivable variable: income brackets, geographic location, levels of education, age, gender, and he discovered that the most dependable, statistically significant predictor of positive well-being wasn't any of those objective material conditions. The absolute number one predictor of human happiness was possessing a strong sense of controlling one's own life.
Money's greatest intrinsic value, its purest utility, is simply buying you autonomy over your own time. It's the profound psychological relief of taking a sick day when you have the flu without spiraling into a panic about missing rent. It's the leverage of having a 6-month emergency fund so you aren't terrified to push back against a toxic boss. It's the freedom to wait for the right opportunity after a layoff, rather than being forced to take the first miserable job that comes along just to survive.
There's a highly illustrative account of a young professional who landed a coveted investment banking internship. On paper, it was the dream scenario. The compensation was astronomical, the work was intellectually stimulating, and the prestige was immense. Yet the intern was utterly, clinically miserable. Why? Because the managing directors dictated every single waking second of the intern's life. They demanded 100-hour work weeks and constant availability. When humans are stripped of autonomy, we experience a psychological phenomenon known as reactance. Reactance is the intense negative emotion we feel when our behavioral freedom is threatened. Engaging in an activity you theoretically love, but doing it on a schedule dictated entirely by someone else, triggers the exact same psychological distress as doing something you actively hate.
Let's contrast that miserable, high-paid banker with the trajectory of Derek Sivers, the entrepreneur who founded CD Baby. Sivers has explicitly stated that he felt he achieved true ultimate wealth at the age of 22. How is that possible? He was working a minimum wage job, but he was living incredibly frugally, sharing expenses, and he managed to save $12,000. That 12 grand wasn't a retirement fund. It was an autonomy fund. It gave him the financial runway to quit his minimum wage job and become a full-time gigging musician. He had complete, absolute control over his daily schedule. He was psychologically rich decades before he eventually sold his company for tens of millions of dollars.
This highlights a profound and tragic irony of modern American life. By every objective historical metric, America is the wealthiest nation in the history of human civilization. We inhabit massive homes, we drive technologically miraculous cars, we have limitless entertainment at our fingertips. Yet aggregate levels of stress, anxiety, and depression are catastrophically high. Why are we so rich, yet so miserable? Because we have systematically traded our autonomy for material accumulation. In the 1950s, a manufacturing worker clocked out at 5 p.m., physically left his tools on the factory floor, and went home. The workday was definitively over. But today, the modern knowledge worker uses their brain as their primary tool.
And your brain never clocks out. It goes home with you. You are sitting at the dinner table with your family, but mentally you are trying to solve a coding bug or strategize a marketing campaign. You are waking up at 3 a.m. with your heart racing over an unresolved email chain. As the saying goes, the modern factory is the day itself. We have voluntarily surrendered control of our time, the one truly finite resource we possess, in order to acquire more capital to buy more things that do not generate lasting happiness.
Which perfectly sets up perhaps the most poignant and penetrating observation we can make about the illusion of wealth signaling the man-in-the-car paradox.
This observation is brilliant in its simplicity. Think about the valets working at high-end hotels in Los Angeles, constantly parking Ferraris, Lamborghinis, and Rolls-Royces. If you observe the pedestrians walking by when a Ferrari pulls up to the valet stand, you notice a distinct pattern. Nobody ever looks at the driver of the Ferrari and thinks, wow, that guy is so cool, I really respect him. Instead, the pedestrian ignores the driver entirely, stares longingly at the machine, and thinks, if I drove that car, people would think I am cool.
It perfectly encapsulates the tragic trap of wealth signaling. Individuals sacrifice immense amounts of capital, and by extension, immense amounts of their life, energy, and time to purchase these exorbitant luxury items because they possess a deep human desire for respect and admiration from their peers. But the paradox is that their peers do not use the luxury item to admire the owner. They simply use the item as a benchmark to fuel their own narcissistic desire to be admired.
It is an endless loop of mutual delusion. If your ultimate goal in wealth accumulation is to secure respect and admiration, you must realize that the horsepower of your engine or the square footage of your estate will never, ever get you there. Humility, kindness, empathy, and being present with the people you love will generate infinitely more genuine respect than a luxury brand ever could.
The scientific data absolutely confirms this. Look at the extensive gerontology studies conducted on the elderly. When researchers conduct deep, end-of-life interviews with thousands of individuals in their 80s and 90s, a crystal-clear consensus emerges. Not a single person ever states that they wish they had worked longer hours to purchase a more prestigious car. Not a single person expresses regret over failing to upgrade their kitchen countertops to match their neighbors. What they universally value, and what they mourn if they lacked it, was unstructured time with their children, the depth of their quality friendships, and the autonomy to live life on their own terms. Your children do not want the expensive toys your money buys. They simply want you.
That is a phenomenal place to bring all of these concepts together. Let's summarize the paradigm shift we've explored today. We started by dismantling the dangerous myth that financial success is a hard mathematical science, recognizing instead that it is definitively a soft skill where your internal behavior completely dictates your external outcome.
We examine the empathy filter, learning that everyone's seemingly irrational financial decisions make complete internal sense to them based on their unique lived experiences. We explored the immense, often invisible forces of luck and risk, recognizing that untangling skill from chance is nearly impossible, and therefore nothing is ever quite as good or as bad as it initially appears.
We tackled the absolute necessity of defining your personal metric of enough to avoid the catastrophic fate of those who risk what they desperately need to acquire what they don't. We marveled at the unintuitive exponential magic of compounding, realizing that the most sophisticated investment strategy is often simply to shut up and wait.
We distinguish between the aggressive optimism required to get wealthy and the paranoid defensive margin of safety required to stay wealthy and survive the inevitable chaos of a complex world. We embrace the statistical reality of long tails, accepting that we can be dead wrong the majority of the time and still achieve massive success if we simply survive long enough to catch the extreme winners.
And ultimately, we arrived at the foundational truth. The highest purpose of wealth is not to purchase depreciating status symbols that trap us in a cycle of social comparison, but to purchase back our own time and secure total autonomy over our lives. This deep dive wasn't really about managing a stock portfolio or optimizing a tax strategy. It was fundamentally about managing your own mind, your own ego, and your own expectations.
It is a complete reorientation of the financial objective. It shifts the primary focus from the external accumulation of assets to the internal cultivation of freedom.
Precisely. And as we wrap up, I want to leave you with a final provocative thought to mull over as you look at your own life and your own accounts. We've established that the true intrinsic value of money is the ability to control your time. But at what point does the relentless, unyielding pursuit of more money actively begin to steal the very freedom you were trying to buy? Have you ever sat down, looked at your calendar, and mapped out exactly how much of your current irreplaceable daily time you were actively trading away for some vague, undefined concept of future freedom? A freedom that, if you simply shifted your perspective and defined your enough, you might actually be able to afford right now. Something to mull over until next time.